And welcome back to the Prescribing Prosperity podcast with your host, John and Alex Soutsos. Although Alex couldn't join us. And if you were in part one of this podcast, you understand that Alex has been laid low by sick children, which is the affliction of a parent everywhere, as a matter of fact. So, John, good to be with you. You're solo again on this episode.
Yeah, thank you, Bill. Always a pleasure interacting with you. And we have a very unique guest on our podcast today by the name of Mark Morris, who's a lawyer and an expert in real estate. And he was just enthralling us in the first half with how things have been evolving in the real estate market in the Greater Toronto area. And I'm sure, Mark, you a lot of what you say applies to other parts of Canada as well. So we'd like to go back to the point you were making at the end of the first episode, and that is, how do we get out of this mess in the real estate market, in the housing real estate market, and the commercial real estate market? And by the way, Mark, in your response, I want you to address industrial real estate as well, because we do have clients who are actively involved in ownership of industrial properties for commercial lending. We also happen to have amongst our clientele a very successful individual who interacts with the powers that be in the municipality. And one of his frustrations is development fees, and the fact that the city can't give up the development fees because they need the revenue, but if there's no development, there is no revenue to give up. So how do you square that circle? So perhaps those two bits can guide some of your response as we continue here.
Yep. So, it occurred to me last session, I didn't thank you guys for having me on this podcast. So let me actually start the way I should have started last time, by saying thank you. It's a real pleasure.
It's our pleasure. Thank you for taking time.
So maybe I can just start off with that last point, and then we can talk about generally how we come out of the cycle. First off, my preposition is that government intervention in the markets long term is not a good thing. It just isn't. And part of what drove the craziness of the last cycle was particularly government intervention, as I detailed with the M2 money supply, COVID, and everything else. But there were so many other government policies that actually led to those failures. Development fees are probably one of the biggest. So let's just take the Toronto instance. People look to John Tory as a good mayor. I don't particularly, from a real estate perspective, I look at it, it blows my mind that that's the case. John Tory in one single year raised development fees on a 2-bedroom condo from $64,000 per unit to $128,000 per unit. 1 year. And the reason, and if you think about what development fees are, just maybe I can back up and just explain, because this is going to talk about development and recovery. When you go ahead and build a building, there are 3 major fees that are built into a contract that people do not see. 3 major taxes beyond HST. The first is development fees. And what that is it's a fee that is paid for every single unit as allocated by door to the city. The second, and technically it's supposed to be under the guise that building pays for building. So whoever it is that's the developer is paying effectively for new development. Second is Section 37 charges. Third is education levies. And the fourth is park levies. I could go into all of them, but they're just basically taxes. Now, if you think about this from the city's perspective, I'm not talking about the structural problem of our Constitution that doesn't even mention cities, and Section 91 and 92 deals only with the provinces and the feds, and as a result, there's not many tax avenues available. If you think about it from the city's perspective, the city can get revenue from exactly 2 sources, pretty much. Well, 3, because they're now Toronto's allowed to land transfer tax, but it's land transfer tax, it's development charges, which I'm calling education, development, Section 37, all of them development charges, and it's land taxes. Now, if you think about it, the absolute worst tax to levy is development charges, period. Because every time you do that, you hinder development. And if you hinder development, you are hindering the long-term viability of the tax base, which is the alternative to development charges. That is to say, if you put up more product, you can tax them over the course of 50 years while that product exists. Whereas if you put development charges in, what you're doing is you're stymieing development all things being equal in markets, meaning less product's going to hit the market because the prices go up. And to the extent that the municipal governments have opted for the relatively easy development charge route because the people don't get thrown out of office for that, in an effort to keep municipal taxes down, and they are, to be clear, at a ludicrous price. My $3 million home, I get $10,000 of taxes a year on that. Like, truly, for the municipal services you get, I'm not one who's trying to get you to raise taxes. I'm saying lower the federal tax, lower the provincial tax, but municipally, the guys who are picking up my garbage and the holes on the street and everything else for $10,000 for a $3 million property, what are we doing? What are we doing? This is a wrong allocation of tax mix.
I so totally agree with you, Mark. I want to throw a little bit of cold water on your complaint there. Do you know what we're paying in Mississauga and Oakville?
Yeah, you pay much more than Toronto. You pay much more than
Yes.
Toronto, but Toronto takes it out of people in an inappropriate way. Because
Right.
while development charges exist in Mississauga, double land transfer tax does not.
No.
And so we are able to lower our price base by putting it on the transactional portion of real estate here in Toronto. And so you end up paying the same amount because you're just paying it up front through the land transfer tax, the double land transfer tax.
Yeah.
My point is, if we tax the transactional as opposed to the mundane, that is to say, the actual municipal tax base, we are talking about an acute assemblage of monies versus a broad-based one. And the broad-based one is always a better way to go and ultimately does not discourage investments. When John Tory raised development charges by 100%, that wasn't a lone instance. Over the course of a decade, development charges had raised and raised and raised to the point where experts like Jordan Sprinkle now estimate that 37% or even more, 40, 50%, I forget what it is, some ridiculous amounts, go to government taxes for every new construction product. And if we're serious about bringing supply online, and if we're serious about increasing our tax base by putting more product out there, we have to municipally look at this and have a serious discussion with our electorate, which no one wants to have, particularly not Olivia Chow, who, I know we're not here to talk politics, is possibly the worst politician I think I've seen in my lifetime. But put that aside.
I will second that motion, and
Okay.
third that motion, et cetera, et cetera. She is up. But you know what,
Bradford
Mark,
for next.
yeah, Mark, the truth of the matter is, when it comes to municipal politics in general terms, that's where the worst politicians exist in pretty much every municipality in the world. Is you're attracting that quality individual,
I'm not going to speak. I'm not going to speak to that because I don't. I was actually involved in provincial politics at the very beginning of my career.
Okay, so they're even worse.
So yeah, my grandfather once said to me before he died. I'm just going to pass it on because I like referencing my grandfather. He's someone who was prominent in my life. He said, because I had political ambitions at one point. I don't anymore, but
Right.
He said, "Mark, you can go into federal politics." He's like, "You can go into provincial politics." He's like, "If you need, you can go into municipal politics." He's like, "But I will kill you if you ever join a condo board." He's like, "And I will come after you with a baseball bat if you ever join a synagogue politics." So I said, "All right, fair enough."
Yeah, very good. Very good. So we agree that municipal politicians in general are incompetent. Olivia Chow is probably one of the worst of all time. And in Toronto, at least in my lifetime, and I've been around forever, as you know. So carry on with your.
Well, here's the thing. Municipally, we needed people who had, in Yiddish they call them Beit Sim. I'll let you figure it out. But we needed people with Beit Sim who were able to have a strong talk with the Toronto electorate and say, "Listen, we're taxing in the wrong way." But now we have a different market-driven impetus to have that discussion because nothing is being built. Nothing is being built, so we have nothing to lose at this point. At this point, the city of Toronto is going to have to absorb the deficiencies. In fact, part of what Olivia Chow was doing in ultimately raising the tax rates was because the development charges had fallen off a cliff since 2022. There's no alternative. And it sucks that our hand is being forced by no alternative as opposed to by design when we could have structured something better. But
You
that
know,
is
Mark,
going to happen.
no one, socialists, people who believe in big government, unlike you don't believe in big government. I don't believe in big government. I'm sure Bill doesn't believe in big government. Big government ultimately goes bankrupt. And unfortunately, that's the only time anyone ever learns a lesson. And so I don't know how we're going to change this track that the city of Toronto is on, or other municipalities for that matter. But obviously in Ontario and in Canada,
Well,
Toronto is absolutely
your question to
critical.
me, John,
Yeah.
was how do we get out of this? And what I'm saying to you is municipal governments, from a perspective of development charges, Section 37 levies, educational levies, park levies, they are they are at the point where the money is no longer coming in. They have reached that nadir. And as a result, removing development charges at this point is a no-brainer because they're not making the money in the first place and they need to promote the product. So there will be some natural backtracking on the hubris that governments have brought to bear on private enterprise in the building space, both in terms of HST, which we're now seeing, where the government is removing HST for purpose-built rental. They've removed HST for first-time home buyers, both federally and provincially. We're just waiting for certain bits to be enacted. We are and we are seeing development charges massively decrease in Brampton for the first time, halved. And we're going to start seeing that happen more regularly, not because we have good politicians, but because those politicians now are sitting there suddenly looking and saying, what? The money is not here? Why? What
Shocking.
possibly could have made this happen? And as a result, that is going to have a natural market correction predicated upon the fact that the tax base simply isn't there. And so they're going to have to find alternative venues, which happen to be a better alternative venue than what we have.
Yeah.
In terms of commercial real estate, first of all, the government shouldn't be involved in any way, shape, or form. I hate the fact that we term multi-residential product of 100 units residential. That's not. It's a commercial investment run by people with big pockets. And the fact that CMHC is backstopping this is insanity. And I don't understand what the hell is going on. But when you're referring to commercial, I'm assuming you're referring to the traditional commercial, that office, the retail, the industrial, the vacant land and the like.
Yeah.
Vacant land. So let me say that a lot of this is a market solution. In 2022, overnight, vacant land repriced to 50% of value on books. It just did, which then, as a corollary, because commercial mortgages really are usually for a year, but no more than 3 years, have now reset the market so that everyone's land holdings have reset, haircuts have been taken, and to some degree, the market does what it does, which is naturally, ultimately revalue land. And that's going to help, by the way, in the further construction. So once development charges fall, once land prices reevaluate, we're going to have projects that begin to pencil again in the normal course once demand returns. Demand is not there. So people can put up a sales center. No one's coming back because they're scared. We need to get through the 2027 cycle. Having said that, I will tell you that market solution is also there for office and for retail and for hotel, because right now people are seeing huge capital pools being assembled for the purposes of buy and hold. They are taking out the weak fish who were able to survive merely because there was so much oxygen in the room that anyone could survive. And those weak fish are taking their haircuts, and fundamentally commercial is resetting. So from the financial health of the underlying asset holders, we've kind of now addressed that. The question you're asking, though, is different. You're not saying, hey, talk to me about the institutionalized investors of real estate. You're saying, where's the market going? What's going to happen now that this has reset? And the answer is, we've already talked about residential. We've talked about 2029 being the part where the nadir kind of stops and maybe we're going to start seeing some upticks. Fine. We will probably see the development cycle attenuate to that as well. That is to say, the first major new projects to be launched again, where they retry, that there'll be a bunch of people who are already sitting on land, and so there's no harm in actually retrying. But if you're talking about the new development cycle, that will probably also take place in 2029, specifically as we know that there's no new product that's coming out and has been sold since 2023, meaning there's going to be 2028 and 2029 with absolutely no new products hitting the market. And so there's going to be demand for new product. And that's when that sales cycle will start. Retail is in a different world. Retail, it's interesting. Retail always had one of the lowest cap rates in real estate. So just to be clear, and I know your audience is financially educated, but just allow me to express
Yes, go ahead.
the
Explain
way.
cap rates.
Right. Okay. So the way real estate is valued is you take the net operating income, that is to say your revenues minus whatever your expenses are before taxes, and then you take that net operating income and you put it over a cap rate, which is just a market-based number. And the lower the cap rate, the more you pay. So if you have $100 million in revenue and the cap rate for retail was say 4%, you would put it over 4%, and that would net you your amount that you would then pay for something that gives you $1 million in income. And retail, the reason that retail was always lower was because your cap rate is predicated upon two things: your return and the risk associated with that not going forward. Retail's risk has somewhat increased over the course of years, gradually. And if you were looking at retail portfolios like Smart Centers REIT or Callaway or a whole bunch of others over the course of the 2000s, I mean, they were all Walmart centered. Amazon wasn't around. It was the most stable income stream in the world. Retail is now seen as a more risky endeavor, even with major anchor tenants. The cap rates are going up, but that is structural. That isn't cyclical. That is a difference in the way we are now approaching retail. Conversely, office, which went haywire and everyone dropped office because everyone thought work from home was the future, has had a resurgence of interest.
Yeah.
And yet the people who are underwriting office also have taken massive hits and are fundamentally weaker than they've ever been, even the pension funds. So teachers funds Cadillac, and Oxford is funded by Omers and everything else. Well, all of these entities have basically allocated significantly less capital to their real estate portfolios, meaning that they have to be a bit more judicious with these assets. They were for the past years for sale. They are no longer for sale. Those sale cycles are kind of stopping. The acquisition cycle of these places are beginning again. And as that happens, and as there's more and more appetite for those commercial properties, the prices will start to go up. So I expect that the commercial market, this is all a long way of saying, I expect the commercial markets to actually start to recover before the residential ones. Development will be in tandem with the residential recovery, 2029. But commercial office and retail, with the structural change, and retail and even hotel will ultimately be the next cycle that turns first. Vacant land is the longest. Vacant land is a 9-year hold. That's where I see things. And so to the extent that retail and office have turned, that's because people are using those services again. And there is value to those services again. And as a result, cash being king, particularly with repriced product, people are finding investment values that are penciling. You will find that the development projects start penciling after the development charges go down and everything else, 2029 onward. And you're going to find the vacant land pencils so long as you structure a 9-year hold, because that's the speculative asset.
And when you say vacant land, you're talking about vacant land within the official plan, right?
Yes.
And within the hard boundaries of the city of Toronto.
Primarily urban centers. Primarily, like I'm talking about the institutionalized, you had a development site, I'll buy that development site and sit on it because you have done nothing with it. That type of institutional money.
I see.
That vacant land is the 9-year hold.
So the let's go back. We're still on the subject of commercial properties here. The industrial plazas where small business owners set up shop and pay their rent. How do you see that unfolding?
Let me predicate this by saying that industrial is my weakest area. It's the one I have the least exposure to, and it's the people I speak to the least. So please understand, unlike I deal with retail all the time. I certainly deal with residential all the time. Please take whatever it is I have to say about industrial in line with the fact that this is particularly not my area. But the way I see that small scale industrial, I'm not talking about like warehouse industrial kind of Amazon sort of thing. We're talking about like the strip malls and Mississauga and everything else that you see with the Tim Hortons nearby and everything else. That is fundamentally 100% tied to economic health and to jobs. And you cannot address that without addressing the underlying health, because those businesses directly serve a population that has existing cash flow. That's pretty much what it is, right? Like I was just at a wine store that I used to buy my kids' bar mitzvah wine in an industrial park somewhere because they do wholesale. And obviously, the amount of wine you're going to buy is predicated upon how much money you have in your cash in your pocket. This is so the real question you're asking is, where do you think the economy is going to go? Because that's going to ultimately allow this to flourish. And I know that it's not de rigueur here amongst the three of us for me to be optimistic, but I will tell you,
Hey, you're
Canada,
allowed to be optimistic.
Canada is fundamentally embracing what it is as a country now, I believe, since the recent government change. And that is, to be very clear, a place that takes stuff out of the ground and sells it. That's what we do in Canada. I'd love to say we do more. I'd love to say that we're 40 million people in a 7 billion person world with a massive amount of lands, critical minerals, oils, waters, and coppers and phosphorates and everything else. And we have decided collectively, after 10 years of putting our heads in the sand and pretending that we are something we are not, we have decided finally to embrace who we are, which is those people who can ultimately take stuff out and sell it. Now, it may not be sold to the same people who have acquired it in the past, but it will be sold.
Mark, I hope you're right. I hope, I sincerely, because leaving the country is a very difficult endeavor. And I'd rather not leave the country. But I hope you're right, because I don't see that. I don't. Mark Carney talks a good story. I haven't seen anything yet. So I hope you're right. I hope all the all the stuff in the ground starts to come up. I hope we abandon this nonsense with self-immolation when it comes to energy, and worrying about the nature of the energy and what it does to the atmosphere and all that stuff, because that's a dead end economic proposition. And we desperately in this country require reindustrialization, which is what you're talking about. And
The reindustrialization is something that I think Canadians are embracing.
I hope so.
And it's, you could do that in environmentally sensitive ways too, but it doesn't make a difference. You have to fundamentally come around to the idea that we have a place in this world, and the place in this world is not one where we are anything other than a production machine for the world. Now, we can refine, we can move up the value chains. I'm not saying that. I'm saying we have to acknowledge where our core strengths are. I do believe that I'm seeing that happen. And this is all to answer the economic question. Our economy, regardless of what you may think of the government in power or whether it's going to happen, functionally, the state of the very asset class you're asking about is predicated upon the successful engagement of us and our investments in ourselves. And if you think that that's going to happen, and we'll see, then you have reason to be optimistic about that asset class. And if you don't, then no, though, then that's the heart of the economy. And if fundamentally we continue the way we continued for the past 10 years, which is a lost decade, it really is a lost decade. If we continue to lose, then no, those people are going to hurt, and those are going to become less and less, and the cap rates will go up accordingly. That's my answer for industrial.
To thank you. To shift gears and you back to residential. There's a lot of people out there who are in their 30s. They're looking to buy their first home. Some of them have given up. And what can you say to them about a timeline for when real estate values, housing will become attainable in the Greater Toronto area? It doesn't have to be in Toronto proper, just the Greater Toronto area. Is 2029 to 2031 the window, you think, where they will actually be able, their earnings will catch up to the point where they can afford to buy something, and they're not going to be paying 1.2 million?
I'm seeing people
paying 700,000.
I'm seeing people being able to afford, because people are taking such massive haircuts through power of sales, that in some instances there are values right now out there. But I'm going to answer your question in a different way, because truthfully, if you're looking to real estate podcasts for answers as to when the market is going to turn around, I am telling you, you are investing incorrectly. You're investing incorrectly, both because you shouldn't listen to blowhards who may very well not know anything more than the next person. And by the way, anyone who tells you with a surety that they know that what's going to happen in an economic cycle or where they are or what to invest in is lying to you. All
Oh,
the
of
people should be
course.
doing
Yeah.
is couching words and telling you what they see as opportunities and allowing you to make up your decision. But what I would tell someone who's in their 30s and about to make their first investment is to embrace those principles that are true as today as they will be in 2029, as they will be in 2039, which is there are ways of getting into the real estate market where cash can be king. And if you embrace a different approach than what you have been taught, you may very well be better off. Allow me to explain. It is the case that you do not need to live in a condo. It is the case that you can invest in a triplex that has 2 income potential units and you live in the basement. Not a bad way to actually begin and substantiate a investment. In fact, if my kids were starting out, I wouldn't be trying to buy them a condo. I'd be trying to buy them a triplex. I'd be trying to get them something that has income. And then when they got it, I might say to them, now that you own property, go ahead and rent and take the rental income from this. And they will say, well, what about the capital gains hit? Well, there's no capital gains if there's no income increase. When the market starts to recover, you can move in there and you can go ahead and then you can get all the capital gain increase you want.
You know, Mark, what you're saying is not different than what happened when I was young in the 1960s and 70s. My parents, as immigrants, came here, and they purchased a home and they put tenants in on the second floor. We lived on the first floor. It was a very small house, but that's what you do, and you're
Right.
essentially that's what you're advocating.
What I'm saying to someone who's buying their first home is don't guess. No. If you know that you can get your income, look, you have a life to live. Get started. Okay.
Yeah.
It's not like you're at the peak of cycle. That's very clear. Well, we can
Right.
definitely say you're not at peak of cycle now. We can
Right.
definitely say that there has been a significant decline. And if you're able to substantiate this through rents, go and be merry.
Yeah.
And that, to my mind, is the way to approach real estate until such time as we know where we are in the cycle. And do not listen to any person or realtor or mortgage broker who's doing their TikTok dance and telling you that you're missing out. Do not do that. Instead, do what's in your financial interest and make sure you can support it.
I think that makes a lot of sense. And speaking with younger people years ago, and who were trying to break into the market, and they were facing a different market than what we have today, I essentially told them the same thing. I said, look, aside from the fact you can get a triplex, you can hook up with a family member, a brother, sister, cousin, or a college roommate, someone that you can share accommodations with and split all the costs. And that's another way of leveraging your cash flow, your limited cash flow, in a way that will allow you to get into the real estate market.
Every dollar you spend on your residential living situation in your 20s and 30s is the most expensive dollar that you can possibly spend because it's money that you're not investing. Investment works by investing early and often. I know you know this. I know I'm speaking to the
Compound
choir.
interest.
Right.
Yeah.
It's compound interest. And people do not understand the power of compound interest. And when you spend it on residential living, you are necessarily diverting it from compound interest, which will, I promise you, by the time you're 50 or 60, give you your security of retirement. And so you need to start looking at this not as something that, oh, your friend got a nice house and therefore I need to get it. You need to start thinking smarter. You need to start looking as a 30-year-old at your true financial future and setting up for it. And that means treating real estate markedly differently than our parents have, or that the advice that your parents are giving you.
Yeah, I think that those are very wise words, Mark, and I sincerely appreciate that. Um, Going back to the person who is older, who has attempted to build their wealth and will rely on that wealth for income in retirement. And so they might be 60, 70, maybe 75 years old, and they want to cash in their chips. And now we're in the trough of the real estate market. What guidance do you have for them?
Well, I mean, look, they're going to save on capital gains. So that's something, I guess.
There's always a positive part.
Look, the hope is that if someone has actually cashed in their chips, they've developed a stack. And the whole purpose of having a stack is to actually hold on through the bad times. We're right now at the nadir. Like, whether we're a year away or not, we are at a low point in the cycle. I am not telling you what to do. You may very well have cash needs. You may sell because you have a great opportunity. I don't know. But if you are sitting on chips, and if you are deciding from a position of true choice, cashing your chips at a time when everyone else is panicking has never struck me as an ideal way of going about things. If you're 85, please hold on till 90. I mean, just do what you need to do. Take your vitamins, because honestly, those chips will be better spent after you have some good vitamin C in your body and you wake up 5 years later.
The medical community doesn't believe in vitamins. I can tell you that, but I do.
That's a totally different podcast. That's where you bring RFK Jr. on.
Yeah, or you can bring me on. I've had some experience in this area. Anyway, okay. Well, generally that's sound advice, but what I often tell people and is that, look, if your bus breaks down, you don't have to stay on the bus. You can get on a bus that's moving and keep going. And that's what we offer people right now, is the opportunity to continue to have their assets grow in a different asset class.
Right.
Because
Actually, John, that's a very good point. The problem is, if you're sitting on your chips, there are so many buying opportunities out there. If you're cashing in specifically to go ahead and make further investments, that's a very different decision than cashing in because you're going to be giving the money over to someone for a bank account.
right.
My advice is predicated upon cashing in, not cashing in and leaving the table. Your advice is cashing in and playing another hand. They're very different stages of life that will dictate a very different strategy.
Yeah. As I said from the in the first episode of this podcast, liquidity in the financial game is always paramount. And even if you're a big time investor in real estate, you always have to maintain capital in a different form, in a liquid form, whether it be to take advantage of opportunities as exist today in the real estate market, or simply to have the ability to live your life as you need to live it. But liquidity is critically important, and this is why I discourage people from having 100% of their assets in an asset class that is illiquid.
You've heard the expression "liquidity is a lifeboat," right?
Yes, of course.
That's what it is. Liquidity is a lifeboat. You're not the first to say it, and it's very true.
Yeah, no, and there's nothing the three of us are saying here that has never been said before. It's just that a lot of people have forgotten what has been said before, and this is where humanity always makes the mistake: is we fail to learn the lessons of the past, so we continue to repeat the same mistakes.
The only thing man learns from history is that man doesn't learn from history, right? That's the expression.
Yeah. So as I told you, I'm Greek and I'm very proud of my heritage. And if you read the ancient Greek philosophers, all the lessons they speak about from 2,500 years ago are still as valid today as they were back then, which tells you that humanity, despite the fact that we now have cars and computers and podcasts, we are essentially the same person we were 2,500 years ago. We really haven't changed.
So I'll end this on a note that panders a bit to your political audience, I think. So I'm going to tell you that when I was in university, I took a course with an unknown professor at that time. It was just me and 20 people in it. And it happened to have been Jordan Peterson before he was famous, and he taught a course called Maps of Meaning, which is actually available on Spotify, and really you should listen to it. It's just the most fascinating stuff. Before he became political, he was a mind that it's hard to describe. Anyways, what Jordan Peterson spoke about was the premise of the course is, I don't care what religion you're from or what your beliefs are, but fundamentally we've only had writing, and we've only had the ability to print and widely disseminate thought through writing for 200-300 years. And yet we've been telling the same stories to one another for 3,000. And we've been doing it, whether you call it Christianity, Judaism, Hinduism, whatever it is, yin and the yang of Japan, or Krishna and Vishnu. He's like, I believe it's all a single story. And his single story was the moral arc and the economic arc of fall from grace and redemption, which is very familiar for Christian audiences, but exists everywhere. And the idea is that whether intergenerationally or personally or anything else, every human being relates to these religious stories and everything else because it speaks to a fundamental aspect of humanity. And that fundamental aspect of humanity is the idea of fall into rebirth. That is true of our economic system. It's true of our economic cycles. It's true of our personal lives. It's true of everything else. You cannot achieve greatness until such time as you have seen the nadir. We are at a point in our cycle where we are relearning and re-exercising atrophied muscles. And it is only through that cycle that ultimately we will have our moral arc of redemption and our economic arc of redemption. And it's important that we recognize we're in that cycle. And it's important that we learn from this experience so that we can then again experience 25 years of prosperity and hopefully have a similar discussion with our kids and remind them of what the 90s were and now the 2020s.
Mark, that was a very eloquent wrap up for this particular program. And I think you've clearly demonstrated your wisdom and looking at the big picture and not just getting caught up in the weeds of the details. We sincerely appreciate the time that you spent with us this afternoon, or this morning, I should say. We're not quite afternoon. We sincerely appreciate the time you spent with us this morning. Sincerely appreciate to get your refreshing take on some hope and optimism for what's going on here in the GTA and the country at large. And we sincerely hope that things unfold as you have outlined. And I hope our audience can take some very valuable insights and lessons from this discussion for their own personal circumstances. Because everyone is, I was reading a Greek philosopher the other day. It says, don't be hard on people because you don't know what struggle they're dealing with. And so it is very true. We need to be non-judgmental and be nice to people because everyone's going through something at some point on any given day.
Gentlemen, I'm immensely grateful for the opportunity. Thank you for your time.
Thank you, Mark. I appreciate that. Bill, off to you.
Yeah, there are so many things I want to say here, but I just want to keep it short by thanking Mark. I really appreciate you being on, Mark. It was insightful and it was useful as well. And John, for those who are listening to this podcast who know you, there's no secret to how to get hold of you, but I ask you this every time around. If those who are listening who don't have a relationship with you want to reach out to you, have a conversation, what is the best way for them to do that?
Our website is medwealth.ca. That's med-wealth.ca. Our email address is info@medwealth.ca. That's info@med-wealth.ca. You can always phone us the old school way, 905-568-2000, toll free 1-888-568-1170. And I would be remiss if we don't give Mark the opportunity to give us some contact details for how people can get a hold of him.
Oh, well, we use a different system. You know the bat signal? I just give you a small picture of me. You put it up against the flashlight in the air, and they're there. You can go to legalclosing.ca. All my details are there, legalclosing.ca. And I would look forward to speaking, of course, to any of the listeners here today.
Excellent. Mark, thank you very much. His email address is, Mark, you okay with us giving out your email address?
Of course, please. mmorris@legalclosing.ca.
Excellent. Thank you. Thank you very much. Bill, take us home.
Yeah, Fred, and that's easy to do. For those of you who are listening to the podcast who are not yet subscribers, the easiest thing you could do is just hit the follow button to become a subscriber. The beauty of that is that next time John and Alex drop an episode of this podcast, you'll be notified. You can give it a listen. I also would ask that you give it a like. Tell people about it. Word of mouth promotion is irreplaceable and invaluable in this world that we live in now when all kinds of things go out and tell us what we might like, and very few people actually do it. So please do. Until next time, I'm Bill Tucker. On behalf of John and Alex and everybody at MedWealth Financial, thank you so much for taking the time to listen today. We'll catch you next time.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.